And joining me now is David Zervos. He's the chief market strategist at Jefferies. And Dave, I think you sum things up well right now and show how different an environment we're in when you say you think there's almost no downside for the Fed in acting aggressively here. What do you mean by that?
Well, Kelly, we talked about this the last time I was on. The housing market is on fire. We've got, more job openings than people looking for jobs. We've got a 4% unemployment rate. The biggest political complaint that's coming back to the Fed through Congress is inflation. It's not jobs. It's not difficulty with the real estate market. So those are really the two that usually come back to bite them when they start on a hiking cycle. So I think they've got a lot of runway, not to mention we just came off a near 30% up here for the S&P. Many people think that may have been too frothy. It's hard to tell, but there are just a lot of reasons why they can afford to go after this 7.5% headline number and try to get it under control, even though the market, much to the chagrin of those that have been bashing on the Fed, the market has got complete faith in the Federal Reserve. Five-year forward break-even inflation, which is my favorite measure of Fed credibility, is unchanged over the last year. It still sits at 2%. That means the market thinks that in 5 years, inflation expectations will still be 2%. Right. So I think it's got a great lineup here to go strong.
Yeah, and I think maybe the issue to show the urgency that you're talking about is to look at some of the shorter-term consumer measures of inflation. So this is what Goldman was writing about over the weekend. They're worried if you look at University of Michigan, 1 year ahead expectations, New York Fed, 1 year ahead expectations. Those just came out updated this morning. They're still at 5.8%. And they're saying if that gets entrenched in a wage price spiral, that could make the Fed want to go 50 in March. Now, is a 2/10 moderation, you think, enough for them to say, no, we don't need to do 50, we can stick with 25?
Well, as I think you also know from a few of my recent discussions, I think they're going to be focusing a little bit more on the balance sheet than aggressive rate hikes. I think they don't want to be seen as chasing the rate market with 50s and intermediate moves. 25s are fine, especially when the bulk of what they did to ease financial conditions during this last 2 years was the $5 trillion balance sheet add. It wasn't the 175 basis points of cuts. That was a minor easing by historical standards. Typical recessions, we cut by 500 or 600 basis points. So I think the balance sheet, and it was very interesting.
But are they going that route? Because as you've pointed out, you think they should do this. This is the way to have the most effect. It would almost be ineffective not to go this route. Esther George has talked about it, but I'm not getting the sense that the rest of the Fed is going to start, aggressively draining it here.
Well, I thought it was interesting in Steve's interview this morning with Jim Bullard, where Jim sort of said, hey, I want to start moving on the pay downs fast, like immediately, which is not what's priced in, but could be an interesting add-on to the March meeting. You say, okay, all of a sudden we're just going to stop reinvesting immediately. So that's one way to be a little more hawkish without doing a 50 and keeping it 25. The other thing is he said something very important. He said, we should have a plan B so that if by the middle of the year the data are not coming in the way we'd like them to, we can begin to open up for the idea of asset sales. And he said that specifically. Yeah. So I think, look, it's there. It's lurking. Jay Powell did not take it off the table in either his testimony or his press conference, testimony for renomination or his press conference after the last FOMC. So I think that's the story of the next quarter to quarter and a half, Kelly, is how do they present the balance sheet to us? And I think they're going to make that a bigger tool.
Shepard Smith here. Thanks for watching CNBC on YouTube.